Hi, everyone, and welcome to the in-depth technical analysis portion of this course. As I already mentioned, technical analysis is literally my baby, so welcome. This is going to be the first practice assignment that you guys really need to take heed to and apply to you guys' charts. I am, for the sake of this section, going to start on the monthly time frame. This is the only time throughout this entire course that you will be using the line chart, okay? So what we're doing today is securing the foundation of our charts, which is very, very important into understanding where we are in the market. So the only way you can make money as a trader is by always understanding where you are and knowing where you're going. So apply it to like real life. If you go, I don't know where you guys are from and where you guys are watching this, but let's say somebody put us in the middle of South Dakota. If somebody put us in the middle of South Dakota, we're not going to know where we are, so we're going to be lost. It's the same thing with trading. If you don't know where you are, you're going to lose money on a constant basis because more or less you'll be lost. So the first thing that you need to do is find 2 points. What you're doing is securing the situation of our chart. So a situation is nothing more than support and resistance meeting each other equally. Okay, so here we have price testing as support right here. We have price testing as resistance. We've already gone over support and resistance, so you guys should already know what this is. But basically, when you have them both together, that is called a situation, all right? It's very important that both of them test equally on both sides, and one of them is not gapped like this, or have an overlay like this, okay? So the first step, and I'm gonna put the directions over here to the top right-hand side, is you are going to find 2 points, find 2 points, 2 points, make your situation, 2 situations, make your foundation. All right, so we're gonna start there. So the first step is to find 2 points. So if I look, I'm looking at this point right here and this point right here. So I'm literally gonna put a line right in the middle there. Now we do not want ugly lines because we want our charts to be as neat as possible, especially as you guys continue to trade. You're gonna add more and more stuff, so you don't want to make it ugly like when it doesn't have to be. So here, these are the 2 points I'm looking at. This is literally tested as support right here, and then I'm gonna put this point right here to test as resistance. Now, we just solidified one situation. The next step is to solidify our next situation. So remember, 2 situations make your foundation. So I am going to put a line right here, and I'm looking at this point and this point right here. But this is the thing. Your foundation must be between 500 and 1,000 pips in range. Now, if you guys trade commodities, let's say gold, then it'll end up being 5,000 to 10,000. But for sake of regular currency pairs, it's going to be 500 to 1,000. And basically everything in the past repeats itself in the future. So once you find these points, you do not have to find any more. So before I actually put the ellipse on these points, I need to measure the distance between here and here. So if I go here, I'm gonna go to date and price range, which is on the left-hand side, right there. This date and price range is 867 pips. That's between 500 and 1,000, so it passes. So now we can solidify the 2 points that we just looked at to secure them. So that is this point right here, and then we have another one right here. So this is clearly tested as resistance and then a level of support. So now we just solidified the foundation of our chart. We're gonna label this in the middle, foundation, and that is that. Now, after we solidify the foundation, what we're gonna do is create 2 zones above and below your foundation. Now, what I'm gonna do now is literally create the two zones. So I'm gonna drag this date and price range box up twice and then below twice. After I do that, that has solidified my zone 1. Above. And my zone 2 above and below. So now I just solidified the foundation of my chart. Now, the significance of these are that these are your monthly key levels. So what I'm going to do over here to the right-hand side is I am going to label these as monthly. So now these are all my monthly key levels. Now, if I look at the date and price range box right here, in the middle, there is a crosshair tool. I'm going to put a line directly on that line. And this line, I'm going to make it dotted. I'm going to drag this up, make that dotted, drag it up again. And then last time, there. Now, the significance of these are that these are your weekly key levels. So I'm just going to label this weekly. There we go. There we go. And then last one. Now, if you come to a different currency pair, I would say definitely try to find the foundation levels in the central. When you find your situations, make sure you find them in the central portion of your chart, just so you have room to go above and below. If not, then I would say like try to find it as close to current price as possible, okay? Now, after you do this, okay, when you're actually trading, the chart looks nothing like this. When you're actually trading, your chart is on the way smaller time frame, all right? And you see literally, you don't see those lines anywhere except this weekly line right here. The reason this is so important is because, again, you always have to understand where you are in the market. So if I were to look through this chart here, right? I see this weekly line, and when I come to this weekly line, the reason that understanding it is understanding where you're going to have those strong areas of support and resistance. So this is clearly going to come back up and test here as resistance. But if I look in the past, and I'm going to show you from like a bird's eye perspective or view, anytime we come to these levels of this monthly or this weekly, we have multiple touches in this area. If we look back through past price, just by looking at these two situation levels, we're able to see the entire support and resistance of our chart. And the reason this is so important is because a lot of people, when they first start trading, right, somebody says, hey, put support and resistance on their chart. And then you have these big, fat, ugly lines that look like this, right? Kind of similar to that first line that was on here. And then people just put lines everywhere. But the thing is what is the strong significance, or what is the strong support and resistance, and what is the weak? How do you know what's going to break and what's not? So being able to understand your heavy levels is a way in which you guys can understand like what is going to hold up and what isn't. Also, by understanding this, I kind of want to put it in perspective of like a 18-wheeler truck, okay? Now, the weekly level that we're at right now, we just got to this level. So you're not going to see like a whole bunch of consolidation in that area. But if we look in the past, just to show you guys an example. So let's say here, we broke through a couple of times. In this monthly area, we literally have price tested here, I would say, for 93 days. But this is the thing. You can trade in and out of these areas, but again, you always have to understand where you are. So let's say somebody is in for a sell on Euro USD and they're selling, and then the market literally goes the opposite way, and then it sells again and it goes the opposite way, and they're like, oh my god, I'm done with this, I'm not going to trade this anymore. And then right when they give up is when the actual sell happens. That's where you always have to understand where you are, because when you come near these monthly and weekly areas, you know you're not going to stay in your trade for a very long, significant amount of time, because you understand that it's at a key level in which price is going to take a while to break away from. The best way I can describe this is like an 18-wheeler pickup truck when you are at a red light. So when you get to a red light and you stop at and the 18-wheeler truck stops, it takes forever for it to actually lose the momentum and actually stop at that red light. And then when the light turns green, it takes forever for it to actually gain the momentum to push away from that red light. So it's the same thing when it comes to price. When you're at those monthly and those weekly areas, look at it as a higher time frame. Is where you have like a lot of volume that has to stop. So you're going to have a lot of consolidation in that range. So that recaps, or that really sums up the first part of the in-depth portion of your technical analysis. I want you guys to really go in on all of you guys' charts and practice this, and I will see you on the next lesson. Hi everyone, and welcome to the second assignment of the in-depth portion of the technical analysis portion of this course, okay? I know I just said a mouthful, but this assignment is literally your ability to make money. Please, please, please make sure you guys follow through and listen to what I am saying thoroughly, because your ability to see structure will be the differentiation of you making money or losing money in the market, okay? So what we're going to be going over today is literally the difference between major and minor structure. Now, major structure is always the overall structure. Okay, minor structure is your right now money, and you have to be able to see them both. So I'm going to literally mark up this chart and show you guys exactly what I mean. But before I do, please just make sure again that you are following close attention to everything that I'm doing. Also, at the end, just like always, I'm going to explain why this is so important. However, please, please, please just take heed to the assignment for what it is, okay? It's kind of like cleaning our bedroom. We have to like move everything out the way so that we can dust and sweep and make it super clean, okay? So things have to get ugly before they get pretty. So we're going to use ugly lines this time so we can really, really see what it is that we're doing, okay? So what we're doing for this assignment is identifying our structure. We already talked about in the basic technical analysis portion of the course of the ability to see your different trends. So if we look at this right here, this is literally an uptrend, okay? This is an uptrend on my 4-hour time frame. So you guys see right here, this is the 4-hour time frame, and the tools that I'm using to do this is over here to the left-hand side on TradingView. I'm using the trend line, okay? Now, I use the lock button so that I can literally go step by step without having to press trend line every single time. So when you guys are practicing this, use the lock button. It will literally help you and save you a lot of time, okay? So again, I just identified a trend line on 4-hour structure. Now what I'm gonna do is break this 4-hour structure down into 1-hour structure, okay? So I'm gonna use the replay, because if I do not, then literally when I drop down time frames, I have to go through the entire whole chart again. So if I use the replay, it will leave me off right where I left off, okay? So here we are, this is 1-hour structure. Now what I'm going to do is identify the 1-hour trends inside the overall 4-hour trend. So here we have an impulse up. I'm going to use this pink color. So we have impulse, correction, continuation. You already learned in the basics portion of this course that this is consolidation. Okay, now we're going back down. So I have this impulse down. I'm going to make this, let's say blue. We have this impulse down, correction, continuation. Now let's talk about this part really quickly. The reason I came down this far is because technically this entire thing is the flag. So in trading, you have multiple names for it. You have flag, pullback, correction. They all mean the same thing, but this is the entire pullback. You see it came down this low, okay? It came up this high, and it came over this far. So that is why I identified the flag the way that I did, just in case some of you guys were wondering. So also for this assignment, for clarity purposes, I want you guys to use 2 different colors to identify your uptrends as well as your downtrends, so that you guys are not like lost or confusing any of your trends or structures with anything. So here we are, we're going back up. We have this impulse here, correction, continuation, correction, continuation, correction, continuation. All right. Now we're going back down. So we have this, again, we have some consolidation. You guys can mark it off if you want. I'm just going to put a whole shift down right here because this is ultimately that overall structure. Impulse, correction, continuation, and then now I'm going back up for the last trend of this leg right here. We have this 1 hour uptrend. So if you were to look at this structure, you see that we have 5 1-hour trends inside of our overall 4-hour trend, okay? Very important. We have 5 1-hour trends inside of our overall 4-hour trend. Now, if any of you guys watch my Sunday night calls that I do all across the world, you guys know that the way that I trade, I use Fibonacci for everything. But in order to understand Fibonacci, you have to understand structure. Structure is key. Structure is king. I do not use a strategy when I'm trading. I'm literally reading the market and being able to understand structure. So again, you have to see the smaller trends inside of the overall trend. So I'm just going to regurgitate this assignment right here before we go to the next part. So structure. What you're going to do for your homework and practicing this, you're going to identify 5 trends on the 4-hour time frame. Then break them down into major and minor structure on the 1 hour and 30-minute time frame. There we are. So you're going to identify 5 trends on the 4-hour time frame, then break them down into major and minor structure on the 1 hour and 30-minute time frames. Okay. So what did I just do? And why is this so important? And I'm going to break down a 30-minute, but before I do, I kind of want to like give you a glimpse as to the process of what it is that we're doing. So again, I use Fibonacci for everything. Fibonacci, you always draw from point A to point B. This is not our Fibonacci assignment. We will be going over it in a few once we actually get to that portion of the course. But if I look at this, and this should be here and here. Okay, so if I look at this structure, we have point A to point B, price pulls back, then continues. And again, if you guys are on Sunday night calls, you know that negative 61.8 is always my reversal. That's how I know the market's gonna reverse. That's how I know when to get out. And again, trading is 3 things: where to get in, where to get out, and where is it going. As long as you know the direction and your entry and exit, you will always be able to make money. So you see literally at this point, the market completely tanks and then goes into a full downtrend, breaking every low that there really is. So this is gonna pull back and then continue further. I'm gonna let this finish playing out. Okay, so as you guys can see, this is literally changing an entire trend now going into a downtrend structure, okay? Now, let's go back over here, okay? So here's the thing about this trend. If we look at this 4-hour trend, I'm going to use date and price range so you can see this. This took 121 days to go 363 pips. Now, you already know a pip is a unit of measurement in the market, okay? And it took 121 days to do so. As intraday traders, nobody is staying in a trade for 121 days. So I just want to put over here to the side, based off of 4-hour structure, we have, hold on, I forgot how many pips. 363 pips. All right, so based off of 4-hour structure, we have 363 pips in 121 days. All right, so let's just think about that and just put that to the side. Again, as an intraday trader, you are not staying in a trade for 121 days at all, okay? Which is why it's super important to be able to understand the smaller time frame. So now on this 1-hour structure, you see that we have smaller trends inside of that overall trend, right? And the reason this is important is because people often say, okay, trade with the trend is your friend, so forth and so on, right? But if you look at 4-hour structure, which is the purple behind the pink and the blue, technically, this is an overall uptrend. But what happens if I enter the market right here for a buy? Now I'm in profit for a little bit, but then the market completely goes negative, right? Now, when this market goes negative, we are in literally here, we are in 112 pips of drawdown, and it takes 26 days for that to play out. Not only that, in order for us to break even, we would stay in this trade for 47 days, which is not happening at all, okay? So why is this so important? Again, you're not staying in your trades that long, and one, God forbid that you did not over leverage your account, but you're not trying to go over, I mean, really 100 pips drawdown, like that is, at that point you lost the trade, okay? So it's very important that you're able to see the smaller structure inside. So if I look at this structure here, mind you, right now we're on the 1-hour time frame, and I do the exact same thing. Let's say I draw my fibs from point A to point B, price pulls back. You guys remember we hit negative 61.8. Negative 61.8 is our reversal. So we hit our negative 61.8, and then this goes completely in an uptrend. Remember, we want to know where we're getting in and out of the market. So now if I look at my 1-hour structure, okay, cool. Now I'm going to keep this date and price range on here so you guys can calculate this with me. Also, you guys don't have to do calculations for your actual practice assignment. I'm just showing you so I can prove a point as to why it's so important to understand the minor structure, okay? So just in case you guys are wondering what I'm calculating and what I'm doing, I'm really just showing you how you can gain so many pips in the same amount of time frame by understanding the smaller structure inside of the overall structure. So if we look at this, you see, again, we have 5 trends. We have 3 pink uptrends, 2 blue downtrends based off of 1-hour structure. So right here, 1-hour structure, and remember, it's gonna be that same 121 days, all right? But now let's count the pips that we made in the same time frame. So this first trade, we have 214 pips to the upside. We have 215 on the downtrend. We have 264 on the uptrend. We have 196 on the downtrend, and then we have 279 back on that uptrend, right? So now we just turned that same 120 days into 1,168 pips by understanding the smaller structure inside of the overall structure, okay? We just turned that exact same days into now 1,168 pips. Now, you guys already know based off of lot sizes, remember, a standard on 363 pips is literally $3,630, right? Now, a standard on 1,100 pips is now $11,000. So think about it like that in regards to how much more money you just made by understanding the smaller time frame. But this is now the problem. If you look at these trades, literally the first one took 10 days, so we'll say about a week and a half. The second one took 16 days, which is 2 weeks. Okay, the third one took 28 days. The fourth one took 27 days. The last one took 31 days. As intraday traders, again, you're still not staying in a trade for a month. Now, this is the thing. You have, just like we talked about on the basics technical analysis portion of the course, you have intraday traders, swing traders, and scalpers, right? My style is intraday trading. However, if you are a swing trader, this is very, very viable and you can stay in your trades this long, right? But again, I'm very, very big on extracting as much money as I can from the market. Okay. But again, you have to be able to read the market, which is why this assignment is so important. So now I'm going to take off this 1 hour structure. And now we're going to break down 30-minute structure. All right. So we're going to use the exact same concept, and I'm not going to do all of the 30-minute trends, but I'm going to do this one in the middle. I always do the longest one for my students just so that they have like literally the most, I would say, price point that I'm practicing on to show them the example. So again, your uptrends and downtrends are going to be 2 different colors. We ran out of our like really pretty colors, so let's use this turquoise here. I hope this doesn't bother anyone's eyes. So we have this impulse correction. Let me put this lock on right here. Impulse correction, continuation, correction, continuation. Now we're going back down. So remember, we're going to change colors. We have this impulse correction, continuation, correction, continuation. Now we're going back up. So we have this impulse right here, correction, continuation. All right. Now we're going back down. We have this impulse here, correction here, continuation, correction, continuation. Now, I'm not going to break this down like this just because both of these are the same low. All right. So you can either put it like that or you can just go one down like this. Either one is fine. That's still just the continuation of that trend. Let me just put that like right in the middle here. All right. Now I'm going back up. Impulse, correction, continuation, correction, continuation. This is consolidation right here. So I'm just going to put a flag here. And then this is our impulse up. Now I'm going back down. Again, we are in our 30-minute structure right now. So we have our impulse, correction, continuation. Same thing like I just said before. This is the same low. So you can classify it like this, or you could just put one push down. All right. And then we have this push up here. We have our impulse, correction, continuation. All right. So I just did this entire pink uptrend based off of 30-minute structure. All right. Now, same concept. Okay. Follow me. Same exact concept. If I were to use my Fibonacci on here, and remember, you guys aren't using fibs yet, but it's very important that you understand structure so that once we get to the fib assignment, you can take advantage of it. So we have point A to point B, price pulls back. You see it hits our negative 61.8, then goes into this orange downtrend. All right. We have point A to point B. Let me actually line this up. This should be here, and then this should be here. All right, so we have point A to point B, price hits negative 61.8, then again goes into this orange downtrend. All right, now based off of our 30-minute structure, I'm gonna use date and price range again. We have here, oh wait, this ended over here. Let me scoot this over here. All right, so Remember I told you guys as intraday traders, we stay up to trades no more than a week at a time, okay? Now, intraday, of course, we're trying to get in and out of the market in a day, but sometimes you might have areas where you have consolidation, and if you want to take advantage of the full trend, sometimes it's not done until the end of the week. But I never really carry my trades over the weekend for the most part, okay? Now, if we look at this, all right, based off of these uptrends and downtrends, and remember, we have the turquoise uptrends and then the orange downtrends. So we have 1, 2, 3, 4 uptrends and 3 downtrends inside of this one pink uptrend on the 1 hour time frame. So we have the turquoise and the orange is our 30-minute uptrends and downtrends, but we broke down the pink uptrend from our 1 hour structure. All right. Now, if we calculate this, we have 112 pips to the upside. We have 72 pips to the downside. We have 102 pips back up. We have 91 pips down. We have 156 back up. We have 75 down, and then we have 123 back up. Now, that just turned into 731 pips off of 30-minute structure. But remember, that is from that one hour trend, and we have 5 total 1 hour trends. So remember, this was our first 1 hour trend, which is the pink uptrend. The blue downtrend is the second 1 hour trend. The third uptrend, which is the one we just broke down in 30-minute structure, is the third 1 hour trend. The fourth 1 hour trend is this blue downtrend, and the fifth 1 hour trend is this pink uptrend again, right? So now remember, we have 731 pips from that one trend. If I multiply that by 5, and remember, it's give or take because we do have some trends longer than others, but generally speaking, we now just flipped based off of 30-minute structure. That same 121 days, we now just extracted 3,655 pips from the market in the same time frame. And now if we look at this, you see this first trade took a day, the second trade took 1 week, the third trade took a day, the fourth trade took 4 days, the fifth trade took 4 days, the sixth trade took 3 days, and then the last trade took 2 days. So you see now we're able to get in and out of the market based off of the smaller trends that are inside of the overall trends. Now this is very important because your ability to take the right now money is what prevents you from being a massive drawdown when you're trading. Because if I'm able to literally, let's say this 1 hour trend, remember the 1 hour trend, let me delete these so this isn't confusing with too much on my chart. Remember the 1 hour trend that we have is the pink uptrend, right? If I got in this pink uptrend, let's say here, for a buy, because remember, trade with the trend is your friend. I'm about to go in this much drawdown. Now, granted, the beautiful part about the minor structure is that, okay, your drawdown will only be about a day, but who wants to go in that much drawdown when I could take the trade for this sell here and then take a buy here and now capitalize off of that? Do you see what I'm saying? So this assignment, again, is very, 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 very important. And it is literally your bread and butter and understanding the market. Now, I do want to tell you, when you do this assignment, you might be confused at first. Keep going and you will start to see your structure. Okay. Now, I've been doing this for a while, so I can see structure like the back of my hand, but this is why practice is very, very key and essential. It's no different than a parent going outside to show their child how to play basketball. The parent can show the child how to play basketball all day long, but until the child goes out and literally practices how to shoot the ball, they will not get it. So you have to practice this assignment in order to understand structure. And the only way you can learn and master your Fibonacci, which is again, your exits and entries, is by understanding your structure and being able to fully grasp it. All right, so that wraps up our second assignment for the in-depth portion of this course. Again, this is the most important assignment of them all. Practice, 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 and I will see you on the next video. Hi, you guys, and welcome to the in-depth analysis portion of this course. I'm super excited because this is literally one of my favorite assignments. And what we're going to be doing today is literally going over Fibonacci, and we are piggybacking off of our structure assignment. So if you guys recall, when we did the structure assignment, I told you guys it was very, very important that you were able to see the trends inside of the trends so that you can understand how to draw your Fibonacci, because Fibonacci is literally going to gauge our exits when we are trading, okay? So first and foremost, what is Fibonacci? Let's go over it. So Fibonacci is a tool that's used to measure the retrace of a counter trend based on the current trend of the market. So again, it's a tool that's used to measure the retrace of a counter trend based on the current trend of the market. So what does that mean? If I have a downtrend structure, I want to see how far price is going to pull back so I know how far price is going to go in the future. Okay, so every time I draw my fibs, I'm always starting at point A, which will always be my 100, to point B, which will always be my 0. Okay, then price will pull back. Now, I use 7 different fib levels to determine how price is going to react once it hits my take profit level. Okay, and what they are the fib levels that you see right here on the screen. So you have 23.6, you have 38.2, you have 50%, you have 61.8, you have 78.6. I'm so sorry, I don't know what just happened. You have 78.6, you have 88.6, and then you have 100. And I'm sorry, I feel like it's a glitch on my computer. Okay, there we go. So again, we always start with point A being 100 and point B being our 0. Then price is going to pull back. Now, in regards to the pullback, okay, price is going to either pull back to one of these fib levels, but each of them means something different. So anytime price pulls back to our 23.6, we are literally expecting a continuation of the trend, or we'll have consolidation in this area, but definitely expect the market to be a little stagnant at this point. Anytime we pull back to 38.2, okay, it's going to be a sharp push down. So just expect it to literally play out immediately. Don't really try to wait on your perfect entry, because the perfect entry is literally there, okay? And then the market is literally going to play out immediately. Anytime we pull back to 50%, typically we'll have a wick in this area, and then we'll close at this 38.2, then make lower lows and lower highs up until the point until we get to our TP1. Now, the only differentiating factor when it comes to that is if we are at like a foundation level. Remember, the foundation levels based off of our monthly and our weekly mean consolidation. So if we're near a high area trend line area, or if we're near a zone, those can be times in which this can kind of like change the rules, but typically for the most part, the 50% you'll wick in that area, then close under that area, okay? Anytime the market pulls back to 61.8, a lot of people call this the golden area in trading. Honestly, all of the fib levels matter. So I do not value one over the other. They definitely all matter. And then ultimately you just have lower lows and lower highs up until the point where you get to your TP1 and then TP2. Anytime you pull back to 78.6 or 88.6, these are very similar, but the market is going to take its time to get to its take profit. So you already learned in our structure assignment that you have trends inside of trends, right, that make up the overall trend, okay? So anytime we pull back to our 78.6 or our 88.6, we know it's gonna take a while before it actually hits our overall take profit. And then last but not least, we have 100%. Anytime the market pulls back to 100%, this is literally like a double top or a double bottom. A lot of people classify it as that. So it is literally where the market comes to the point in which it originated from. So if I start here, I'm testing the area as either a double top. As you guys see, this is literally a downtrend, so that would be tested as a double top. And then if it was an uptrend, let's actually put an uptrend fib on this structure so you guys can see. If it is an uptrend, that will be tested as here, point A to point B. Remember, point A is always 100, point B is always 0. Then the market will pull back. This is what we call a double bottom, where you literally both of them hit the floor. You see that? And then it goes up, ultimately up until I take profit once and then take profit two. Okay? Now, I said something when I talked about the 23.6, the 38.2, and the 50% that I did not say with the 61.8, 78.6, 88.6, and 100. And what that was when I talked about the 23.6, 38.2, and 50%, I talked about price hitting our TP1. Then when I talked about the 61.8, 78.6, 88.6, and 100, I talked about price hitting TP1 and TP2. Now, I want you to think about it like this, okay? Let's say you drop a ball, and let's say it's like a subtle little bounce. It's not gonna bounce that high in the air. But if you pound the ball into the ground, then the higher is gonna bounce into the air. Does that make sense? So let's use actually an uptrend fib so I can show you guys this, okay? So think about it like this. And remember, we always start point A to point B. So that 100 will always be point A. That point B will always be 0. Then price is going to pull back. The further you bounce it into the ground, the higher it's going to shoot up in the air. Okay? The more subtle bounce that's not really that hard, it's a little bitty bounce, it's only going to go a little bit in the air. Or you can think about it like a slingshot. The further you pull a slingshot back, the farther something will shoot. So think about it in that perspective, okay? Now, the reason fibs are so important is because it always tells us where we are exiting the market, okay? I'm gonna go over entries in a few where we talk about how to enter on these fibs. But when it comes to actually exiting the market, okay? Remember, trading is three things: where to get in, where to get out, and where is it going. So with the structure assignment, we identified where it's going. Now, in understanding where we need to get out, if I'm here to here and I enter here, and remember, we're gonna go over entries in a few, so I got you guys on that. But if I'm in this trade right here, right, I need to be able to determine, is it going to my TP1 or my TP2? And also, when it hits my TP2, remember on the structure assignment, how my negative 61.8 is always my reversal level, okay? Now, again, the only time some of these rules can sway a little bit is if you're on minor structure, and I'll show you what I mean in a second. But to draw your fibs, and I have some on here, but I'm gonna do a few from scratch also. So let's just say we use this, right? We go from point A to point B. Now, you see here, price only hit 50%, wicked up, literally came up, touched this level, came up, came to our 38.2, retested our 38.2, then continued up, right? But do you see how it only hit our TP1 and not our TP2? So this is why it's very important to understand always where you are in the market and also what is going on. So here I have, this is my 50% fib, okay? And then it happens over and over and over again. You can really find your fib structure anywhere in the market. Let's say we look at, okay, so this is a 23.6 that I already have on here. We have point A to point B. You see this pulled back to 23.6. Then it came down to our negative 27. So you see how it only hit TP1 and not TP2. Another perfect example of that structure, okay? Now, when I said that sometimes rules can be broken, is I want you to look at this minor structure here, right? So remember, anytime we have our, like for instance, this 88.6, technically 88.6 is supposed to be a slow retrace up into our TP1 and TP2, right? But because this is a pullback, okay? Remember assignment number 2, you have trends inside of trends. The overall trend is here, here, here. So this isn't necessarily going to be slow inside of this minor structure that's here, because we need to have the continuation of the overall trend. Okay, so it's very big and very important, like I mentioned in assignment number 2, to be able to see the trends inside of the trends. But if you guys look at this trend alone, you see we have point A to point B, price hit 88.6, hit negative 61.8, and now you're out of the market. That is your trade. That is your money. Okay, now all I want you guys to do when you're practicing this is literally just go through and practice finding every single fib level. So for instance, we found the 50%. We see that 23.6 right there. I have a few actually already in this chart. We can find a few more from scratch. Let's just see. And then also you have fib structures that's inside of other structures also that you can gauge to see what the continuation of a trend is. So let's say we were in a trend before this 50% hit, right? So let me just delete this. And let's look at this previous structure that's kind of going on over here. If I draw my fib, I want to draw it from this lowest point or this low point of this new high. Okay, so this is a new push. I want to draw it from that low to that high right there. All right. Do you see how this is literally a 100% retrace? We have point A to point B. Price literally, I'm sorry, let me pull this up because this point B would be here. Okay, you always want to go to where price stops. So this first trade would be here. Let's say this was the very, very first trade, and that was that first fib, right? And what I'm kind of trying to show you guys is how you can have fibs inside of fibs. So you see we hit this 50% and then we hit this negative 27. That Fibonacci structure is now done, okay? Now you have another trend that is on top of this trend, which is here, here, here. Okay, so I want to make sure you guys see this, because remember, again, just like the second assignment, you have trends inside of trends. All right, so now based off of this fib structure, if I literally move my fib to this new high, you see we have point A to point B. Okay, and I'm gonna delete the blue off so that it doesn't confuse you guys. It's actually gonna delete the purple also. So let's draw the purple back on here. We have point A to point B, all right? Price pulls back. Let me line up that point B really quickly so that it hits exactly my, hold on, let's let it hit exactly. You want it to, oops, you want it to line up as much as possible. So let me take off this annotation, pull our fib structure down to where it touches perfectly here, okay? So we have point A to point B, price pulls back to this 100. So now we have this double bottom structure, which is really just a level of support. Once we get to zones, this could also be a zone that's drawn here. And then ultimately it just finishes out this structure. But once that hits our TP, it hits at our negative 61.8. And as you guys see, it literally goes straight into our new trend structure, which is our downtrend. Okay, but again, I just wanted you guys to see how you have trends inside of trends. So even though we had that 61.8 or we had that 50% inside of there, this would be a 100%. Do you guys see that? So again, it's very important to always be able to see the structure that's within the structure. Now, what I want you guys to do for your assignment is I want you to literally find all 7 fib levels on whatever pair you trade, okay? I want you to find all 7 fib levels on whatever pair you trade. So we literally just looked at 50%, we looked at a 23.6, we looked at a 100%. We saw that small structure 88.6. We can really go through and let's actually try to find some more. So let's say we look at, let's see. This is like a 61.8 right here. Yep. So you guys see how this is point A to point B? Price pulls back. Let me even this out. Price pulls back, hits our 61.8 structure right here, then goes into this uptrend, hits our negative 61.8, then reverses. You guys see that? So it's very important. And again, you always want to see the structures inside of the structures. I'm using 1 hour structures, 1 hour structure and 4 hour structure for your main fib is where you expect those reversal levels. Because remember, when you're on minor structure like this, right? When you're on minor structure like this, your structure can easily be broken because it is the minor structure that is making up the overall structure. So I'm sorry to be so repetitive and redundant, but I really want to make sure you guys take heed and understand that because it is everything, okay? So again, go through and find all 7 fib levels on each pair, and I will see you guys on the next lesson.